Hi guys, this is Terry with Futures.io. It is my honor to welcome back FuturesTrader71 for today's webinar, Tying It All Together with Trade Execution. This is the final part of his multi-webinar education series. If you have questions, you can type them into the questions box and we'll do our best to answer them at the end of the event. Also, if you're watching this on YouTube, please do us a big favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. Don't forget that you can now follow us on Facebook and Twitter at FuturesIO. And without further delay, I'll hand it over to FT71.
Good afternoon, everyone. All right, let's find the correct screen, get this rolling. So there's a lot to cover here, but I don't want to turn this into a feature film. My goal, as I told to Terry, is to keep it to about 45 minutes, so it's not daunting. But the main purpose of today's webinar is to take what we covered in the prior series, and I'll regurgitate that just a tiny bit to refresh. The main purpose is to get it to the point where it's not theoretical. I'm not some educator that's coming on here and is spewing out some theoretical stuff. I'm a trader, and I'm sharing this with you to help you find a way to execute a little bit better. So I'll start out by saying derivatives trading involves substantial risk of loss. It is not suitable for all investors. Past performance is not indicative of future results. So let's start out by talking about pinning down your trading technique. So this, execution is where the rubber meets the road. This is the point of contact between you and the market. It's a key area of competence that you have to acquire, and it's a key problem area for pretty much everybody who is not seeing consistency in their trading already, okay? So I suggest you go down, as it says in the last bullet, watch part 1 of the series. It's on YouTube, it's on my website, it's on Futures.io. Just grab it there. It talks about trading technique, and I define some of the elements of a trading technique, including sharing my background and how I arrived to where I arrived. I want you to focus not on how I'm trading or what I'm using to trade. It really is irrelevant for this discussion. So I'm not looking to convert you into a volume profile trader or a price action trader or an Elliott tier or anything like that. That's not really what's important. What's important is how you bring that information or that skill set or that technique to interact with the market and what your expectations should be. The first step in pinning down your trading technique: define your time frame. Know that there's no right or wrong way. There isn't. We can argue till we're blue in the face, but the fact is there's really no correct or wrong way of trading the markets. It is what it is, and you end up, you have to end up being the master of whatever approach you use. It doesn't matter if you're tossing a coin, really. It just has to be something that has an edge over a substantial or relatively large sample size. Get your approach down to a routine process. One of the third part of this series, which I felt like I didn't really get the point across very well on, is trading habits. It's a key part of coming down with a trading technique that is something that you can turn into a habitual routine, and it's almost something you don't think about. A little bit like driving a car. You don't have to think about how much gas, how much to press on the accelerator, how much to press on the brake, when before the intersection you should signal, things like that. You want it to turn into something that is very fluid, okay? So I invite you to watch part 1 of the series to get the heads up on trading techniques. The next part that leads into your execution is seeing your performance with the right mindset. Your mindset is everything. How you come into the market, what your perceptions of money, making money, your perceptions of the market's treating you. Are you someone who thinks that, who believes that things happen to you, that bad things happen to you? Are you a victim? I'm not degrading that in any way, but it is not the right mindset for the market. It's you don't want to be in a position where you're handing your control over to some other idea, even if that idea is something you truly believe in. In the end, to execute well, you must know that you're the one in control. Watch how you speak to yourself. Watch your words. And then the other part of a mindset, to keep a clean mindset, is to stick to your limits, right? Violating your limits is not only something that's expensive because you just paid out a lot more to the market than you were willing to or you had planned to in order to find out if your trading plan would work. It creates a distrust, and it removes the coherence you need between your actions and your beliefs as to who you are as a trader and how you participate in the market. Watch part 2 of the series for this. The trading mindset's a really, really important part of who you are. The next part that we covered is simplifying and raising your focus by building key habits. Habits are just so understated. It's not something that traders will talk about a lot. We talk about psychology, we talk about technique, and we'll go into hours and hours of Fibonacci retracements and whatnot. But really, your habits are who you are. So build a series of habits that drive you toward a focused goal. You know, just your habits should support what you're doing on a daily basis, which support what you have set forth as your goal for your trading for the week. Very, very few people set goals and work towards them in a deliberate way. When habits become unconscious, execution becomes more clear, more fluid. I'm going to say that again. When habits become unconscious, you want your habits, good habits, to become unconscious. When I'm trading, I am not thinking of every little thing. I'm just executing. It's unconscious for the most part. In fact, I get caught off guard, or I used to a lot more with my traders when they say, why'd you do that? It tends to throw me off. I'm following a process, and it's mostly unconscious, and it takes care of the noise. I don't have the noise in my head when I'm about to interact with the market. Get your errors under control. Good habits lead to lower errors, and execution errors are likely your highest cost. Most people think their highest cost is their commission or their software. Your highest cost is your errors. If you track your errors, if you diligently look at all the errors that you're doing, and I've covered this topic in other webinars at Futures.io. When you look at your errors, the cost is tremendous. This is what's eating your lunch if you're not seeing consistency. It's the errors. It's the difference between what you said you'll do and what you actually did that constitutes an error. Watch part 3 of the series to go over habits. I want to take a step back for a moment and put out this poll. We're going to spend 30 seconds on this poll, not more, so if you intend to vote, do so in 30 seconds. And the reason for this poll is to get to know what we have as far as an audience. So there's the poll. Please click one of those and let us know. It's anonymous, so be honest. Don't feel like you have to impress anybody. Nobody's going to know what you voted for. It's completely anonymous. So go ahead and click, okay? We're approaching 10 seconds, 7 seconds, 5 seconds, 3, 2, 1. 70% of you voted. All right, you're still voting when I cut you off. I apologize, but we need to move on. And then a second part to that poll. 30 seconds for this. Does your trading execution meet your expectations? Does it happen with consistency, hardly ever, seldom, or never? It changed the order of these, I think. So does your executing your plan, is what you're doing on a daily basis in the markets meeting your expectations as far as your plan is concerned? 3 seconds, 2 seconds, 1 second, and it is gone. All right, let's share the results real quick. Here's what was said. So for the question, how many live trades do you execute per week? About 60% of you, less than 50. That's about 10 live trades per day. 10 live trades per day. See, they're much more active members here. That's good. 50 is a decent number. And then as far as does your execution meet your expectations, the greater majority, by a slight margin, is seldom, which is why you're here probably. And it is, and rejoice, because this is a very, very, very consistent issue among traders. So don't feel like you're there's something wrong with you or whatever. 69% of you voted. And it looks like 33% said that your trade execution meets your expectations with consistency. I hope it's a positive expectation that you're setting for yourself. So let's switch gears back. Let's take a look at, now we're going to move from the theory and the background, which was covered in parts 1, 2, and 3, and move into what really goes into execution, right? So what are the final steps to get down to execution? And the final steps for me, and this could be different for different people, essentially you could spend a lot of time doing a lot of homework, and ultimately it boils down to taking whatever your process is and boiling it down to just a routine, right? So we talked about this in the past in the Habits webinar, and your final steps to get down to execution consist of the morning prep, the last look at the market before it opens, and the finalization of what you're likely to interact with the market on. So most people show up and trade. Those who are not following a systematic approach or a trading system, most people show up and basically play it by ear, in my experience. They just say, well, we'll see what happens, and you know, I feel like the market's selling off today, so they'll look at the short side. It's better for you, and I know this through my traders, my own prop traders. It's better for you to set your key ideas for the day, okay? And I do this through what I call the writing down your hypotheticals, okay? Generally there are 5 hypothetical trades that can occur. Those are general ideas, and then you can narrow those down as you come in after the Globex session. If you're trading a day session on a product that is US based, you can narrow those down and or expand on them. But ultimately your final steps to execution need to be something that brings you into a space where you're focused on what is the market saying and what are my key trading ideas as I come into the day, okay? And the way I do that, and I share it every day on this thing called a Trader Bite. If you are not familiar with what a Trader Bite is, it's been going on. I've been publishing these. They're very easy to publish. I do it on the fly. It's a live streaming broadcast every morning at 9 o'clock Eastern. And essentially what I'm doing is I'm taking what I put together as a market overview overnight, and I look at what happened in the Globex session as I come in at 7 a.m. Chicago time, 8 a.m. Eastern, and I look at what the Globex session has done and try to, my goal is to narrow down what are the 2 most likely scenarios, sometimes 3, but overall I have about 5 plans, sometimes 7, that can take place in any given day. My focus really, because I like to simplify and narrow things down, otherwise as an engineer or as someone with an engineering background, I end up complicating things. I end up focusing on the 2 key ideas of the day, and that's what I'll stalk as far as trades. This is a key step for you. Why? Because doing this allows you to have a flexible mindset or an open mindset. or a growth mindset, in that you're not coming in with a preconceived notion based on yesterday's action or your performance from yesterday, and you're looking at the market objectively before it opens. Once the market opens, you essentially change as an analyst. It becomes harder for you, for most people, to be as objective, especially after putting on a trade and taking a loss early in the game. It's hard to get that to recover the objectivity. So what I'm sharing with you here is a recent day, the 14th of October. This is the pre-market. This is before the market. So we're looking at the 13th right here. Let me get my pen, my trusty yellow marker. And so this is the 13th right here. This was Thursday. Thursday we happened to gap down. We tested September's lows. We found buyers and we rallied back up to Wednesday's range, which was a pretty tight range that Wednesday. And so what I do is come in on Friday. I came in on Friday, and I'm looking at, okay, what is the market doing? And essentially what it's doing is it's trending down, but it's gapped up. So essentially it has broken out from this trend down channel, if you're a price action person, and we're trading up at 36.50 by the time the trader bite was taking place that morning. And so I look at what is the primary idea, what is the secondary idea, and sometimes what is the tertiary or the third idea. And this is what they are. And you can watch these every day before the market. There's no hindsight to any of this. Simply we're setting up and looking at what the market is setting up to do. And then the next day I review what I expected versus what actually happened. And if I know why or can determine why, which isn't all that common, I can then explain what that is and use that information towards today's trading, that morning's trading. So the primary idea on the 14th was that the market is in a gap up. The prior day's high is 32.25. It's trading 36.50. This is the S&P Mini, in case you're wondering. And the primary idea is that the market opens at an open auction. So you can see here that it is expected to be sideways. Then I'm looking for the market to respond back, to move back to the most recent trading range, to test the prior day's high, day session high or pit session high, and then to consolidate. It's already broken out of this channel. I'm expecting it to consolidate, find buyers, consolidate enough to find buyers, and then start to meet its objective of pushing to 44.50 and then eventually to 52.75. That's the key number that we're looking for. So that's the first plan. That's the primary hypothesis, okay? The secondary possibility is that the market opens at an open auction and does not have sellers in it. Does not have sellers in it, so it trades sideways at an open auction. Okay, so back and forth, and then eventually it compresses enough, or a higher time frame player, an OTF or a participant, kicks in and takes it up towards the 44.50 again, and then ultimately we're looking for 52.75. There's a higher probability on the secondary hypothesis to get to 52.75 because the daily range statistic is easier to attain, right? Because if we drop, it's farther away to move to 52.75. So that's the secondary idea that I'll be looking for, and essentially I'm walking into the market and waiting for the market to confirm which one of these ideas is more likely to happen. I don't know which one it is, and I won't pretend to know, and if I do, you can disregard, you can discredit my comments because I just never know what the market's likely to do. So I create multiple plans and just respond accordingly. The third idea is to have an open auction. It attempts to go higher, but then find sellers. It's just a weak push higher, find sellers, rotates down, and then retests this what's called a point of control, this pink line, which is the most traded price from the prior Wednesday. And then once it breaks into the Thursday range, it's likely to test the most traded price from the Thursday's range, the prior session's range, which is at about 2127, 2127.50, something like that. I don't remember the price. So that's the third trading idea for the day. So as the market starts, as I go over this and do the trader bite, and I shut down the trader bite, my next process is to get into a very short, like 3 to 5 minute meditation, and then wait for the market to open up. Those are the final steps to get down to execution. So we just did this. We just went through the trader bite. We looked at the market's intentions, what it's likely to do, and I emphasize what it's likely to do, or probably, never a definitive opinion of the market. I think if you take a definitive opinion of the market, you are fixing your mind to a certain outcome, and it's going to be impossible for you to be flexible, to actually respond to what it's saying. So it's really important as part of your execution, as your part of your quest to become better as a trader, is to continuously keep a flexible mindset, okay? So now what I would like to do is walk you through this day. So here's the end of Thursday. This is a day session only chart, and I'm going to walk you through, and we do these walkthroughs at Stage 5 Trading quite often, actually more often before than now, but I'm going to walk you through on a bar by bar basis of what trades set up and how I'm stalking them and taking the trade, and then how it's being managed. So that's essentially, those are the steps that we're looking for next. We're looking at, okay, we've got our reading, we've got a plan on the market's intentions. Next, we want to identify what it's likely to do, identify the risk and its value, then execute, look for protection upon execution, managing the trade, with scale outs, with all these other techniques, and then exiting the trade and completing the cycle, which includes taking yourself out of the trade, whether for a stop or a target, and then taking a moment, because there's seldom a time when the market will fill you on a stop or on a target and immediately you have another signal. It does happen, especially on more volatile days, but generally this is a good time once you close a trade to just chill, record the trade as much as you can. Don't get narrative with it. Just record what it was and what the setup is, and you want to track the results. The recording process should be electronic, so you can search through it. So what we're going to do is I'm going to walk through this day, identify the opportunities and why, and go over why, and then show you on a heat map what those opportunities yielded, and how those trades may have worked out. Let me see. Let's see why this is not running. Okay, here we go. So the market opens. It's 9:30 Eastern, 8:30 Central. The market's opening, and you'll notice that there's a profile that's being built as we go along. I use volume profiling in my trading. It doesn't have to be this way. So there's the market. It immediately tests up to 2140 and down to 2137.25. Those are my opening swings, so I'm going to move my opening swing lines to mark them. So I'm doing that as I go along. There's nothing to execute on. My 3 trade ideas, just as a reminder, okay, my 3 trade ideas is an open auction. It drops, holds at the prior day's high at 32.25, and then I'm looking for a large move up. So the key element of this plan is there's a large move up, and I'm going to be looking on the bullish side if that happens. The secondary idea is also bullish, looking for 44.50 and 52.75. I'm looking for a large move up. Also, it seems like 1 and 2 are the same, except 2 never really dips. So if it doesn't dip, then I'll throw 2 out, and it leaves me with 1 and 3. And in 3, we have an open auction. It pushes higher on an impulse, which could set us up for hypo 2, right? That throws out hypo 1 because there was no dip. It sets us up for hypo 2, which could be a push up to 44.50, a pullback, and a continuation to 52.75. My key trades are into the 44.50 and into the 52.75. If neither one of those happens and it rolls over, then I'm looking at hypo 3, and I'm going to be short. I'm going to be stalking short. Just knowing which side I want to be on is actually putting me ahead of all the other traders who are just coming in and trading from their emotions or gut, right? So that's an important point to remember. So here we are. We have an open auction. It's going back and forth, and it looks like we just broke higher. So I'm looking at potentially hypo 2 or hypo 3 because there's no dip yet. Okay. So as we move forward in time, we see that there's strength on the buy side, and there's really no push to the downside. So if you look at the delta down here, you'll see that the market, the volume is trading on the buy side for the most part. There are other things I need to look at that I cannot replay right now. It will take too long to set up a replay. Things like the underlying, the 5 key underlying sectors of the S&P 500 and so forth that support that idea. My index chart, which actually represents today, not the 13th. I'd have to stop and load that data. I only keep 1 day's worth of data. But this chart tells me which products or which other futures contracts are in control and which way they're pushing. And so here, what I have at this point in time is the potential for hypo 2 or 3. So it's either likely to push to 44.50 with a pullback and continuation to 52.75, or it's likely to push higher, fail, and then start breaking lower, which gives me hypo 3. Okay, so right here is a trade setup, and I'm going to show you this on my execution platform and heat map. Here you go. So I'm going to try to scroll forward here until we get to where we are. So there's the market open. So this is the market opening. This is the heat map of the market opening. A lot of trades going off right at 8:30. This is all Chicago time, so it's 1 hour behind Eastern. And when I zoom in, okay, I'm going to keep moving forward. So I'm going to create some parameters for the execution right now. The parameters are I only trade 1 lot at a time. Okay, so just for the purposes of this exercise, I'm only going to trade 1 lot at a time. I have the ability to get up to 3 contracts to scale in or take on 3 contracts maximum. I'm trying to make this, my goal is to make this as relevant to you as possible. And I'm going to walk through the process of, okay, how am I managing risk? Let's hide this column because we don't need it right now. How am I managing risk? What this is showing here, this is a heat map of the order flow and the depth of markets. It's showing me where the bids and offers are. This is what you're seeing in the white Z lines. The bigger the offer or bid, the wider the line. The dark is the inside market. Usually this has the lowest volume in it, like you see here. At this exact moment, you can see that the offers are 288, the bids are 352, and there's a huge offer up here, and that's what's making this white. And the beauty of this that makes it not like other software that you might have been familiar with is I can go back and see how long that's been in there. How long has that order been there, or that accumulation of orders been there? So what we want to do is get to the point where I'm stalking for hypo 2, which is a pullback, push, pullback, and then up to 52.75. And I see an opportunity. So I want to forward to that opportunity. I'm just now becoming familiar with how this works. So let's just play this. Okay. Let's go. It's interesting, it's not replaying. Let's enlarge this. All right. This could be not so much fun if it's not running. So let's try that. I think I'm just stressing. Let's slow this down. Yeah, this should be updating. We're actually at 11 o'clock already. I'm looking for a trade, and it would be unfortunate if this didn't work. I'd have to figure out why that is. But let's go back in time. I'll show you. Unfortunately, I wanted to actually take these trades as we were going along, and it's not doing that. This is something I need to let them know about. But the first trade I wanted to take was right around here. Let's let that reload. So here it is. It was running. There we go. So I'm looking for the long off of the mid area. We have a higher low here, so I'm looking to get long in the 39.50 area or so. Okay, so that's what I'm looking for. Let's pull back. I think what's happening is it needs time to actually process the incredible amount of data that it's going through here. It's going through the entire depth of market. Here we go. So my goal here is to get long, again, get long around this 39.50 area. That's the point of this, on a pullback. So I'm looking for a pullback to down here. You can see there's a fair amount of orders that we pushed through, a cluster of collisions here. And what I'm looking to do is get long this, this area. If it chops around, then I'll sit through that. The only thing that'll push me out, if we go back to this chart here, as we push forward, the only thing that's likely to push me out if we start to push through the opening swing low. So I don't want it below the opening swing low. I got long in here. Okay, so 39.50. 39.75 is it? Yeah, 39.75 is where I got long. Why isn't this moving? There was a major update to the S5 bookmap software, and I think the replay is not playing nice yet. So I'll have to figure out why that is. But in any case, what I wanted to show you is, as I get long, my first point of concern is this zipper cluster right here, this consolidation. Okay, as we push through, this is the area that I have to be concerned with. The highest volume in this area is right here at 41. Notice it actually hit 41 and fell off. That's really the key area of concern. I keep fast forwarding too far and then having to reload. I apologize. Yep, right here. Okay. So let's resume. It'll take it a minute to load and then start running. And what I'd like to do is manage this trade with you. So I'm long from 39.75, was it? Somewhere in here. Okay. So that trade is gone. So I'm looking for about 39.75. Sorry, let me back this up a little bit. Okay, so let's get long right here. 39.75. My first exit area is going to be 41.75, taking a little bit of heat here. The last low is at 38.50. The areas that I want to watch out for is what's in this box right here. And the key area to be concerned with is this cluster right here. This is likely to show the first point of resistance on a price action basis, and I have a little bit of protection at 37.50 in the form of some size, but I'm looking to scale out, and I'm not sure why it took away my order here, but I'm looking to scale out at 41.75 ahead of size, but I'm also looking to add, and the idea is I'm trading hypo 2 right now. I'm expecting it to push to 44.50, and then essentially this would have filled the 41.75 right here. Okay, and that would have actually taken me out with a one lot, and so what the market is doing, I didn't get an opportunity to add, but what the market's doing is it's pushing through the zipper cluster. Once you have this move here, so let me pause this a second. Once we have this move up from right here, I start to use whatever cluster it had just formed, this little zipper consolidation here. I start to use that as a way of gauging what is likely to happen next. So since I entered this trade at 39.75 right here, we push up, we pull back, and now my expectation is that it's likely to struggle here, push through. You can see there's a lot of size, or unusually high size on the offers. The market is pushing up, so it's likely to fail up here and rotate lower and push lower, and we'll see what happens here. See how it's you can see the buy side is very strong. You see that circle getting bigger. The buy side is very strong. It pushed. We have a collision at 42.50, and once I see that the collision at 42.50 and I've entered at 39.75, I'm going to be protective. I'm going to look at the latest, the smallest cluster right now. So let's zoom out, and I'll show you that it's not very strong, but this small cluster right here becomes how I'm going to control the trade. And if it pushes through and below there, I'm going to hit to sell the market if I were still long, and exit the trade. See how the size is starting to build up above 43 all the way up to 44? The idea here is that as the market pushes up, we generally see size decrease as fake orders get canceled. It's set to, oh, there it is. Okay, thanks a lot. I have no idea how that changed. The idea is as the market moves up, this size will generally cancel, not increase, and what we see is the market starting to add more size. So as the market gets closer and closer, as these executions get closer and closer to these prices, normally we see these turn from white to gray as more and more people cancel. But what's happening here is that they're actually going from gray to white, which means supply is coming into the market. So this idea that we're going to take, let me pause this. I'm trying to manage a lot here. I'm going to pause this. I'm going to show you this on a 2-tick Renko. So there it is. We pushed into the 43.25 like you see right here, right? 43.25, and you see these collisions, a lot of volume going off against these offers. And this is why watching the tape alone, in my opinion, is a much harder way to go. It's better to be able to see where the bids and offers are, and that's what the specialty of this software is, and why I execute on it. It was a lot harder to learn to do the tape and read the order flow when this didn't exist. But now you can see, going back, that there's a lot of volume that started to come into the market, and these collisions here mean something, in that here's the market coming up and filling those orders, and those orders are not moving. And so you have this supply coming into the market, and there are the weak hands right there falling off. Okay, so I'm off of the long idea, and remember, we're trading right now, we're going for hypo 2 right there. A consolidation cluster, look at how that looks versus what we expected, a consolidation cluster, and then it started to break higher. At the 43 and a quarter, our first target was 44.50, as you see in this setup here. A consolidation cluster, first target's 44.50. The market stopped at 43 and a quarter, and the question now becomes: is it going to rotate back towards this 38.75 again, and then find a consolidation and push higher? In which case, I would look to get long, and I could. My goal is to have an opportunity to pull 7 or 8 points if it does continue higher. So the next thing I'm watching for, as I'm executing the plan, is does it pull back to 38-ish or so, or this to the lower end of the range, find buyers, tick through the opening swing low, and then get an impulsive move up. If it doesn't, then I'm going to start looking at what am I going to look for if it starts to fail through the consolidation structure from this morning? What am I going to look for? Anybody? Take a guess. If it starts to fall through the opening swing, yeah, I'm going to be stalking what? Number 3. Number 3. So number 3 becomes consolidation, break higher, fail, find the sellers. Do you think we found the sellers here? Could we have possibly found the sellers with so much on the offer, even though the market pushed and traded against it? Look at these green circles, these pie charts that are mostly green, are representing buy orders on the offer. These are buyers that are taking the offer, and they're doing it aggressively, but they're meeting supply. And if we meet supply and the demand is overwhelmed, what is likely to happen? Now we found our sellers, right? Those sellers are now sitting in a stronger position, and now the buyers are likely to get squeezed out. So now I'm looking for the short side, right? So as the market rotates over, I'm looking at the short side. I'm looking at the short side, and what's the first trade that I have going for me on the short side? The first trade is a pullback, is a pullback to this cluster right here, pull back to this area right here, to this zipper. I would like to see it push, pull back, gives me the mid trade, mid short with protection with this volume cluster. If I get the mid short, which would be around 40 to 40 and a half, my risk is above 42 and a quarter. If my risk is 42 and a quarter from 40 and a half, then I have a very legitimate target now of 33.50. So I'm risking a couple of points, okay? So we said 40 and a half to 42 and a quarter. I'm risking about a couple of points, and from 40 and a half to about 33.50, I'm looking at 7 points. So my risk reward's about 3 to 1, right? This would be a very favorable trade if that's what happened. Now, that's what's going to happen. So you can see there's a gap zone here. This is a voided area that has not been traded. Once the market pushes through, it is likely to push through to the other side, which brings us down to 33 and a quarter, it looks like. And that's the trade. That's the first available trade on Hypo 3. Again, here's Hypo 3. I'm doing my best to help you tie your overall plan with execution at the tick level, at a very, very short range level. Okay, and so that's what I'm looking at. I'm not, notice that when I was taking this trade, I didn't have orders sitting. I didn't load the book and put all these orders here and join all these guys. I don't do that because I don't know what's likely to happen up here. I'm looking for the market to interact at those prices, and as it moves up, I am one tick lower, ready to hit the bid to sell to the next best bid if I see that the market is struggling to push higher. This skill set comes from starting out as a scalper, but it's something that anybody can learn. So as we push forward, so where's the setup? The setup is we have an impulsive move down. So now I'm looking for a pullback to around 40.50. If we don't get a pullback to 40.50, the initial balance is in 37 and a quarter, and I'm going to stock a pullback. If it pushes lower, if it pushes down here, I'm going to look for a pullback to 37.25 at least. Okay, if it continues to push lower. Ideally, it's actually gone a little bit far now. Ideally, it pulls back, comes up to the 40, 50, and then we get the continuation trade. That would be the ideal setup. It happens often, not all the time, but it is what it is, right? So let's move forward in time. It'll start playing in a second. Let's pin this, let's see. All right, what's the story here? Yeah, I'm not sure why it's not replaying. This didn't happen in the prior version. This is in this release. It's not actually doing what it's supposed to do. So there it is. There's the update. So we've pushed, looks like 39.75. Where are we now? 9:30. So this is early still. Okay. So it looks like it's not updating until I tell it to stop, which is not how it's intended to work. Oh, we went. Oh, I told it to stop instead of pause. Let's move up in time here. So here's the next setup. So I'm looking at, so the market has already dropped. The market's dropping. Here it is, 10:01. This is about where we are in this platform. Okay, and so the idea here is that I'm looking for a pullback. Let me reduce these dot sizes so we can see what's going on behind them. So the market has pushed down and we have a precipitous fall here. Now I'm looking for a pullback to the IB low. Again, here's so at this point the market has actually pushed farther than I would like. Now the next setup is 37.25. I cannot do anything until it gets back up there. So let's replay this. I apologize, it's not working the way it's supposed to be, but this is a beta version. Everything else works fine except this. So I'm looking for 37.25, and in setting up 37.25, I'm looking for this area here for protection, the small cluster of volume for protection. I'm looking for the IB low. I'm selling the IB low right here, and I'm looking for this to push up and then start to struggle, and as soon as it rolls over, I'm hitting the bid short, and then the first target will be 33.75, and then of course the next target is going to be the prior day's low, and that gets me 37.25 down to 33.75, so that gets me 2.5 points, 2.5 points or 3.5 points, and then an additional 2 points or 1.5 before I'm done with the trade, before I get to the runner. Okay, so this is not working. It's funny, we tested it this morning and it seemed fine. Maybe if I do 1x it'll work. Yeah, so it works fine in 1x, I think. It doesn't work so well when I speed it up. So I do need to speed it up, otherwise we'll be here for days. We're already past the 45 minutes. Pause, replay. It's unfortunate. I wanted to show you the actual execution and protection of a trade, but I can't mess with that for very long. So let's walk through this. Okay, so here's the pullback area I want to trade against, 37.25. I've got a little bit of protection, a little bit higher. I have the mid at 38.50, so I'm not too concerned if it pushes all the way up to 38.50. Okay, the trade is absolutely missed because now it's pushing towards our target. I'm not interested in that short immediately. I'm not interested in that short anymore. I'm not going to chase the market. It's okay. It's one trade, right? I have to stick to my plan. My plan was impulse, pull back to 37.25 or to mid, preferably impulse down, pull back to mid up here with some pretty good protection behind us on the zipper, and then look for the extension through the IB down towards 33.25, and what it's done is we've had a very, very small pullback, and we've put in a zipper right there, a cluster. This will come into play in a minute as the day goes on. So I'll just call out the trades. I don't remember what trades I took that day, but I'll just call out the trades as they happen. Here it is. It is pushing into the prior day's range. This green line is the high of the prior day, right? This is our key target initially. Again, I'll draw you back, and I'll keep doing this as much as I can. I'll draw you back to our initial plan. Remember, we did this before the market even opened. And here it is. We're pushing to 32.25. We're expecting a small bounce towards the opening cluster, right, towards 37.25 for our purposes once we opened. And it did not do that, so we missed the trade. Here it is continuing to push. Let me make sure this is correct. Yep. Okay, and it's continuing to push into the next day's or the prior day's range. I have now, what do I have as potential trades for the short side? I have a low volume node right there. I have the IB sitting right here. I have the mid sitting right here. So this area here is very important now. This 36, 37 area is the next area I want to interact. If I don't interact in this area, what is my other trade that could set up? Can anybody take a guess? I know this isn't fun when you're watching the video later, but I'd like this to be more interactive. What is the next trade that sets up if I don't catch the drop into this key target? This is the key target of the day. Long from 21.31, long to mid, okay? Long from where, though? Long to mid from where? Where would I get long from? Remember, I have a plan. From the prior day's point of control. The prior day's point of control is this price right here. That's exactly right. I have a point of control, and I have the prior day's close clustered together. I have a very balanced cluster from the prior day, a very balanced high volume node, and the long is pretty much free and clear all the way down to this 21. That's a terrible line, by the way, but all the way down to 21.21. I can start to stalk. Even if it pushes through, I can stalk back into a long, back into the point of control. The key element here is that I have an impulse, a continuation, and then if it continues lower, then I'm looking for an impulse, continue, and then the continuation dies out near this point of control. So let's see what happens. I'm going to leave those scribbles on there. And so the market pulls back. There's the pullback. Consolidate right against the prior day's high. It's unable to get out of the prior day's high. This is too noisy. And it continues to push lower. See how it's starting to firm up. There's not that much selling going on anymore, and it's starting to firm up. And now I'm looking for this continuation. There it is. So do I just put my order at that price at 26.75, 26.50 and hope the market hits it and I get long? Do I do that? Do I want to do that? Let's forward this and use the hand to go back. No, we don't. At least I don't. I'm not interested in standing in the way of the market. So here it's pushing. Here's the pullback, and now it's pushing through. Let's see, is that correct? No, it's earlier. Okay, here it is. So this is the drop right there. Okay, there's the drop, the continuation. Let's zoom out a little bit more. There's the 43.25. Push, pull, impulse down, consolidate, continuation down, pull back, and then it has another continuation down into the prior day's point of control. And so what I want to do down here at the prior day's point of control is look and see, do I have pretty good bids here? Are these firm bids? Looks like the bids were there all along. You can see at the bottom of the screen, watch this number right here, right down here. Watch this in a second. It tells me, there it is, the bids there are about 1,200 contracts on the bid, and they're increasing to 1,300, and then boom, they're hit. See that? It goes to 706. They are hit. Somebody hits those, and then they immediately go back. There's the 1,300 again, and it's nice and solid. Okay, that's not enough for me to get long. That's not enough for me to get long. What I'm looking for now is this is a significant figure here. Remember, this is the point of control the prior day. This isn't some random number or some random spot that it moved to. If it were, I would not have a trade, I would not be stalking, and I wouldn't be trading because then I'd overtrade. What I'm looking for is a bounce, a pullback, and then I want to see the bids firm up in all these prices. I want to see the bids firm up just like they're doing here at 21.28. Consolidate, have a hard time, and then start to move up. As soon as it starts to move up, I'm getting long, and I'm going to start targeting whatever's above, and we'll see that in a second. So let's look at this chart. So here it is. It hits the point of control, right? That's fairly common. There's the bounce. This is the bounce that tells me, hey, buyers are in here. So now I'm looking for the corrective move. What does a corrective move look like? You have this whole thing's an impulse, pullback, consolidate, continuation, and then a push up, pull back, and then it gets corrective. Then I'm looking for the push higher. And the push I'm looking for is towards the 35 even, which sets me up for an exit of the long and potentially an entry into the short from 35 to 37 and a quarter. That area becomes an area that I want to explore to the short side. Okay, so the long on this day would have gotten me one scale out and would have gotten me actually a loss overall, because on the second attempt the long would have gotten crushed here on this fast move down. So there's a loss, an overall loss. It was a small short-term win, but an overall loss on this trade because the Hypo 2 failed. Hypo 1 doesn't work. We scrap that. Hypo 2, again, let me refresh your mind. This is our plan. Hypo 1 was expected to drop, consolidate, and push higher. Hypo 2 was expected to consolidate from the get-go, push to 44.50, pull back, and then push to 52.75. Hypo 3, remember this is all pre-market, consolidate, push higher, fail, and keel over, and then give us the target that it just hit. Okay, so overall, this I'm shooting for Hypo 2, and I learned that that didn't work because we took a loss here and the market started to push down, so we're looking for the short side. The short side did not give us a trade, so you're sitting there, a loss still, and then you're looking, and then the idea is you look for the next key area. The next key area is 26.50, 26.75. I'm looking for the consolidation and the move, the consolidation and the attempt higher, so I'm looking for a zipper to trade against here, and I'm looking for the long at 29.75. So this pullback right here, the cluster, it pushes through 28.75 and then gets through that cluster, the zipper cluster. It's unfortunate that we don't have this, folks, but it's all right. We can live with it. So here's how I look at this. Here's how I'm stalking and taking the setup. This is the push from the low. This is the pullback, consolidate. It fails through right there. It fails through. Okay, and now this becomes my control, this area here. Once it gets taken out, I'm looking to get long with them, and I'm looking to get long into 35, which is the mid. Okay, so that's the setup, and there it pushes through, and there's the impulse into the mid. Okay, hang on, I'm waiting for my charts to do their thing at 4:30. That just ticked away. Hopefully I'm not confusing everyone. Let's go back to our day. Okay. Let's move forward. Here we go. This is our day. Okay, here it is. Right here is the setup right here. So I have this consolidation. Okay, pull back, higher low, higher low. I'm looking for the long, and I'm looking for the long into 35. Okay, let's see what happens. There it's struggling. And now we look for our exit. I front run my trades by 2 ticks, looking for an exit on the long, and then we're stalking the short. So I'm looking for the short here, and it's important for me to compare what my chart's showing here at 35 at this time, 12:33. I'm looking for what happened here, what happens here to help me get in on the short. Look at all the size at the mid right here. See how it suddenly all cancels? This is caused by this quick burst up. The size cancels, so I have to be cautious. It's likely to run through the mid, which is running at 35 at this point. The mid is right down here. That still doesn't mean that I walk away from the trade. I'm now looking for a consolidation. Okay, I'm looking for a consolidation and a quick push up and a rotation down to enter. That's the pattern I'm looking for. So there's the consolidation. Here it is. And I'm looking for this little push up right here. So now the short's at 35, hit the bid and manage the trade. And I want to walk through the trade management here for a minute because that's a topic that I intended to cover. So as the market pushes lower, it takes out the 33.50, which was the last low. So this is all price action stuff. As I look back in time, I start to identify areas where the market, so the trade triggers right there, right there. Just remember the spot, even though it shifts. I'm starting to pay attention to, since I got in up here at 35, I'm starting to pay attention to the last volume cluster in the area. So this is an area where I expect the market to consolidate once it gets down here. So once it pushes into here, I expect it to run into some turbulence, if you may. And there it is. So it moves from 35, runs into turbulence, pulls back, then it breaks through. You can see the size hitting the bid there. Sellers are control. It pulls back into the turbulence for continuation. Once, and this is a key point that I want to share here. Once it pushes through this a new zipper cluster, and it continues to fail through, that becomes, this is my control. This is my risk control. This becomes the point, the area that I would be watching to make sure it doesn't just push through and go back to my entry here at 35. So that's what I wanted to cover. So we've identified and stocked the trade. We executed with some protection, and that's the protection that I'm talking about. It's the market moving in your direction, consolidating, and then continuing in your direction. That consolidation becomes my risk control. Okay, and then the next, so I can keep going through this, but I don't want to bore you to death with something that's already happened. Hindsight's 20/20, so I don't want to keep doing that. Okay, so here's the 35. That's the consolidation. That's the little poke up, the sell signal, and then as soon as we get the next zipper, this zipper becomes the control, the protection that I talked about. Here it is, pulls into 33.25. If I did not get the 35s, the next area I'd look for is that 33 even. The middle of this consolidation here becomes the next area that I would look to stock short if I believe that, or if my target was expected to be much lower. Okay, and so it continues on its merry way. Here's another consolidation. So as soon as it pushes through this next consolidation, I move my protection from here to this noisy area. So what I do for this is I put a profile on it, and I identify the point of control. So now my next protection is, I would not want it above 32.5, and that becomes the protection. The market, if the market will continue in my direction, it is not expected, I shouldn't say shouldn't, but it's not expected to push through that 32.5. And as soon as it does, right there, I am done. I am done. And let's see what happens next. Oh, it continues lower, but it does push through. And that's really how I'm executing, okay? So I might have lost a lot of you here, but I just wanted to show you how you're always focused on you're grounded. You have a grip on the big picture. You have already preset what you're going to do, and then you want to execute, because everybody has to interact at the market at the tick level, so don't knock it, right? Execute using order flow, and then as soon as you execute using order flow, you're looking for immediate protection of your trade. In the form shown, you can have your protection as a volatility stop, or there's a billion ways to do that. But my method is to just see what the auction is doing. I'm following the auction very closely. It seems exhausting because I'm talking a lot and it's a lot of information. But as you watch this happen, you start to see how it unfolds on its own. And it's a lot like describing how to hit a soccer ball. If you had to talk through it or hear someone talk through it, it sounds like a massive undertaking. Okay, put your foot here, point your toe here, shift your weight forward, kick from the hips, you swing your arms this way, all that stuff. It seems like a daunting task. But anybody here can see a ball on the ground and kick it without any thought. And eventually that's what we're striving for. That's where we want to go. Managing yourself during the trade, really important. What do you do once you execute? Where do you look? Have you figured that out? Where are your eyes pointing once you've executed a trade? Are you immediately looking at your dome and trying to figure out, oh my God, there's size here, oh my God, there's a bid and I'm short, or there's an offer and I'm long? What are you doing to manage yourself during a trade? What I always told my prop traders is, as soon as you execute, the best thing you can do for yourself is to either minimize your dome and go back to the chart that created the trade. So this chart here for me, my trigger chart, is the chart that created the trade, right? So I just go back to it and I evaluate the trade based on what is happening on the hard right edge. Okay, this is the problem with people getting in, then continuing to focus on their dome, and then once they get out for a tick loss, tick win, scratch, the market starts to unfold, then they look back and they say, I have no idea why I did that. It was so idiotic for me to get out. How did I not see that it was likely to break down? Look at how beautifully it broke down and I was short. It's because they shift their focus from the chart or the time frame that they are planning in to a time frame that's not theirs, and that is the tick, bid-ask tick level, and they lose sight of what the plan really is. And you really need to come up, as part of your execution plan, you need to come up with a way to manage that. The way I used to tell guys to manage that is, as soon as you execute, just close your eyes and breathe and focus on your breath. It's almost like a little meditation. Close your eyes, focus on your breath. If you just enter the market, it is not likely, assuming this is not an error trade or a FOMO trade or an impulsive trade, it is highly, highly unlikely that within 30 seconds of entering the market, there's another interaction required by you as part of your plan, that you immediately need to close the trade within 30 seconds. It's not likely. So get yourself through the first couple of minutes or whatever they are. And I used to say, just close your eyes, even turn your chair, and just focus on your breathing. Let the market take its time. Let the market breathe. I'm not saying ignore your risk, but I'm saying just let it do its thing. Let it work, okay? So come up with a plan for that. Once we exit the trade, it's really important to have some sort of a log. I use OneNote for that, or Evernote, a running log of the trades. Actually, Google Sheets, Google Spreadsheet would be great, something that you copy every day and delete the prior day's notes, and just keep track of buy, sell, price, buy, sell, time, price, what was the setup, what is the error code if there is one, and comments. It's as simple as that. Okay? It's as simple as that. Just it takes you away from the market for a minute. Why do you want to be taken away from the market for the minute? Because you want to regain that composure, lock that, lock the trade into history, because the very next trade is not at all affected by the prior trade. And in that way, when you look back at the market, you missed a few bars at least, and it requires you to kind of re-look at the market and readjust or reset before your next action. Good trades that will cost you. As part of this, as part of trading, there will be a decent number of trades that you planned, that you waited for, you were patient, you executed beautifully, and they just didn't work. And the response by most people is that they need to change their plan, or they need to change something about how they execute. They should have done something. Why? Because they gain insight. They gain insight once the trade is done. They've gained some insight that they want to apply to the very next trade. Guess what? The very next trade is connected, but it's discrete from the prior trade. An analogy, a silly analogy. You have a relationship with someone, everything's great, then it falls apart. And for whatever reason it starts to fall apart, you then take that, whatever it is that went wrong, and change who you are, and then start to assume that the very next person you're with is going to be the same, and start to take action from that regard. The outcome is not likely to be very good. Just understand that despite your best efforts, you are going to lose. You're going to lose on the most perfect trades out there. It just takes one participant in the entire globe in the market you're trading at that moment to nullify your trade, to trigger your stop, or to cancel your trade. Just one participant. So just stick with your plan. If you believe in your plan, or if you believe you have a good plan, and go back to trading techniques and so on, stick with your routine and habits and look for the next trade. I want to leave you with this thought. When it comes to execution, your focus should be on putting all those four parts together that we've covered. Your focus should be on making yourself ready to execute. Most people want to wire money into their brokerage account, get their username and password, load the software, set up their charts, tinker, and then they want to execute. Because unless you're executing, you're not trading. Unless you're executing, you're not a trader. This is a deception. This is an amateur thing. Your focus should be on all the pieces that precede execution. Execution is the final piece that you will eventually have to master and overcome. But unless you master your trading technique, then master your mindset and have a good one for trading, and then master your routine through keystone habits, good habits, and in coming up with a plan for how you will engage with the market, manage a trade, close it out, and then move on. It's all for nothing. You're essentially going to continue, in my opinion, just continue to pay and pay and pay and not see progress. And you'll end up starting to believe that you're not designed for this, that this is not for everyone, that this game is rigged, and so on and so forth. So your focus is not on execution at first. Your focus is on those three other parts. You've got to have those all together. It's like trying to put up the roof to a house on 4 pillars without building a great foundation and putting up walls and putting up interior walls and then setting the roof on top and then finishing the house. Most people would love to just show up and put the roof on top, grab a mattress, and call that home. And it's not really how things work. Okay? If you have any questions, hit me up at FuturesTrader71.com/contact for a detailed explanation of all this stuff. There's a full-on walkthrough that I've done with live data, like running data, on my website, FuturesTrader71.com. It's called Webinar 5. You might want to take a look at that. It expands on a lot of this stuff. This ends the series for this series that I've done this year that started back in May or June. Hopefully you're followed along and your trading is better for it. That's the goal here for both FuturesIO and for myself. That's all I have for you, Terry. You're still here.
Okay. We got about 15 minutes, so we'll do a small Q&A.
Okay.
Let's see.
You want me to cycle through these questions here?
Trying to get back to the top and
yeah, keep shifting down.
okay, let's see. If you trade Globex, what are the important areas numbers you use to trade RTH from the Globex?
Well, I don't trade Globex, but I do pay attention to it as part of my prep. You'll see me reference it in that Trader Bite every morning. This chart shows both RTH and Globex. RTH is the gray and black profiles. Globex is the gray and blue. So I'm going to go back here to the 14th. This is the 14th. So I'll pay attention, like this particular session, the Globex session of the 14th, the session we just traded. You can see that there's a distinct the duality to the auction. In other words, there's a double distribution here. You can see there's a lot that occurred near the highs as the market pushed up and into the and caused it to gap up, and it traded quite a bit down below. I will use this information. I will look at the gap in between them and use that as a low volume note. I'm applying the same ideas to Globex, but I don't trade Globex and I don't weigh it as much as the regular trading hours. And the reason for that is Globex is not really an orderly auction. Globex is just continuously trading off of other markets. It's trading in sympathy with Asia, then it's trading in sympathy with Europe, and it's not being run by the underlying stocks, and that's why the volume is just not there. Look at the Globex volume here versus what happens as soon as the market opens, right? So it's not really substantiated, but it's meaningful in that I want to know where the distributions are. I want to know where the point of control is from the Globex session and so on. Again, this is just one way to trade. I don't want to push volume profiling on anybody, but I don't trade the Globex session. I don't have statistics on the Globex session itself, so I'm not really qualified to answer that question. I just don't want to say something that is not that I'm not using or that's not true.
Okay.
But it is still important.
Okay. If all of your hypotheses are proven wrong within the minutes of the open, what is the right call of action? Should you adapt on the fly? Should you stop trading for the day, or should you go back and redo your Trader Bite for that day?
So it's impossible for all of the hypotheses to be thrown out right at the open because they're designed for the market to do something. It's going to go up, down, sideways, and it's going to go up, and then it's either opening in range, in value, out of range, above or below, and so we're covering all scenarios. Think of this. Think of the hypotheses as like war. Okay, you don't send a battalion into a field of battle and say, hey guys, let's go out there, let's see if we can gain some ground, let's play it by ear. It doesn't work that way. You don't know what the enemy is going to do. I'm not saying the market's the enemy. Don't look at the market that way. It's unhealthy. We don't know what the other side is going to do. So what we're doing is we're saying, I know my strengths, I know the weaknesses for the structure that I have here, or my plan, like trend days are a weakness for me. If this thing opens and it just jets in one direction, like if it had opened on the 14th, let's say, if it had opened right here and just went into a trend day, I'm sitting that out. I don't have a plan for when that happens, and I know that trend days occur about 18% of all days on any given year, or in the data set, and it's about a 2,500 day data set. They occur about 18% of the time. 18% of the time, I don't have much to do, okay? And I accept that as part of the process. But in general, my 5 hypotheses, and I focus on 2, I covered 3 for this particular day because of the gap. One of those is likely to hit. But let's say you have an event at some point in the day that kind of blows everything out of the water. What kinds of days blow everything out of the water? Can anybody think of what day during the day all of a sudden the market just goes bananas? FOMC, exactly. And so on those days, on an FOMC day, let's say this day was FOMC and there's the FOMC release, let's just pretend. What I do is I trade the beginning of the day under hypotheses that are covered by the trader bite, and then as the FOMC takes place, I essentially pretend like this is a new day and this is the prior day. It is part of the same session. It's a clock that keeps ticking. Yes, I get that, but the market is processing new information, new and important information, and so what I'm doing is essentially saying, what is it doing compared to what it did this morning? And I essentially come up with you know, 1 or 2 or 3 hypos right there on the spot. If I lose track of the market, if I take a loss and I take another loss, and now I'm starting to get this thing in my mind that, oh my God, you know, what am I doing next? What I do is I just stop, I pull up this chart, I stop, I back up to the beginning of the day, like this, just like that, okay? I reread what it's trying to do, and I step forward until the current moment. Okay, looks like sellers took over at the beginning. It pushed through. It pushed into the prior day's range. It failed to hold the prior day's range. This is today. Failed to hold the prior day's range. Now it pushed through mid all the way to the high. So I'm looking for a pullback to mid for a break of the IB high at 39.25. That's what I was looking for today. I'm stalking the long side. As soon as it pushed out of the prior day's range, out of 2130, and push through the mid, I'm looking for the long side today, okay? And so I walk it through, okay, looks like there's a pullback, there's a mid, there's about a mid trade right there. I'm going to look for that long, and I'm targeting the 39.25. Oh, it did not work. I get my 2 scale outs, and then I have to stop out once it turns around and goes back to the mid. So I'm resetting and walking through that again and again, and recreating hypos if something dramatic happens during the day. It's a long answer.
Okay. Let's see. What is the significance of the mid statistically?
The mid, okay, so it seems like an odd thing. The mid, let me define it. The mid is essentially the center of between the high and the low. So I refer to mids in 2 ways. It's either the mid of the day, which is this blue line. So all this is doing is it's taking the RTH high so far plus the RTH low so far divided by 2. It's that simple. But I also look at the mid of rotations. So for any given rotation, there's an indicator here that gives me the 50% in between. So as I click on this, you'll see this blue line, and I use that to just gauge the action. Now, the mid of the day is a statistical, a very painful statistical study that I did a long time ago, and essentially basically under certain circumstances, we have when we have an impulsive move away from the most recent balance. So what does that mean? Here we balanced up here. So we balanced and we formed this big thick profile, right? And then we have an impulsive move away from it. I generally look for the mid to be the cutting point. If there's going to be a continuation in that direction, the mid is generally the cutting point. And I know fibbers are going to say, well, wait a minute, there's a 38.2 and then there's a 50% and there's a 62, a 61.8 and there's a, I'm not complicating it in that way at all. I'm just looking at the mid. When the market drops on an impulse, pushes back through the mid like it did today, it cancels. I'm no longer looking for the continuation of that move. And that happened, that's exactly what happened today. Today it looked like sellers all the way until, so we have the biggest rotation of the day is right there, 5.25 points down, followed by 4.75 points. It pulls back to the mid. I'm short the mid, one scale out, and then it starts to push through. I'm done. I'm done with these trades. Are no longer, this setup is no longer valid. I'm going to start looking to the other side. It tested the prior day's range and pushed back out, and the mid is kind of the final yardstick or frontier. And you don't have to use the mid. You can use whatever, VWAP and whatever else. But the mid for me is just a way of gauging how the market's behaving. And the mid cannot be used when the market is imbalanced. So if the market is doing this, right, and it's expanding, let's say, but it's still doing this, and the mid looks something like this, and it starts to shift down, and it does this, I'm not trading against the mid. You'll get chopped to pieces doing that. The market is telling you that it's balanced on both sides. It's day traders trading, throwing the ball back and forth. There's really no edge there, so I stay away from the mid on those types of days. Anything else?
Do you use a resting stop, or do you manually exit your trade when it fails?
So I don't recommend this. It requires you to have an excellent platform and data feed and internet, but I don't ever use resting stops. I'm not recommending that. There are excellent reasons to use stops, especially if you don't have your discipline in check. In fact, if you don't have your discipline in check and you tend to frustrate yourself with what you're doing versus what you expect to do, then you should not only have your stop, but you should immediately put out your targets and not touch them. But for me, I'm managing risk with size, for one, so I'm manipulating the unit size of the trade during the trade to improve my theoretical average. I won't get into all of that, but I'm improving the overall position, the average of the position, by manipulating the size. You can do that once you're trading multiple contracts, but I'm also using this structure, like I showed, the protection, to figure out how the market is likely to behave. I never know what it's going to do. I'll be the first to admit that, but how it's likely to behave tells me to get out before a stop would even trigger. The biggest problem that I see with people trying to trade, whether it's equities or futures or whatever, is they choke off their trades too soon. As soon as the market moves a point in their direction, they put a hard stop, they move it to break even, and then they're wondering why their commissions are so expensive and how they've lost all this money on commissions mostly, not trading losses. And that's because 1 point, giving room of just 1 point to a trade in a product that ebbs and flows in 2.5 point rotations or 3 point harmonic rotations, it's not a very good plan, because there's a high probability that your stop's going to get triggered, especially a fixed stop. I just don't use fixed stops because I want to stay engaged with the market, and I don't have the risk of, I'm on a fiber optic line direct to my clearing firm. You know, it's a different setup. So I'm not recommending you don't use them, but I find that using them causes me to be more passive. It's just not my style of trading.
Okay. Can you explain how you use the opening swing high and low to aid in your trading decision?
So the opening swing, and I get this question a lot. So for today, the opening swing was, I believe it was 39.25 down to 37 even. The opening swing, first of all, let's define it. The opening swing is simply the first proof or the first indication that we have a seller and the first indication that we have a buyer. And so what we're looking for is for the market to open, push, and once it turns, that will be your opening swing high. It is not dependent on time. It could take as much as 20 minutes or as little as 30 seconds. And then it turns the other way, and then the market auctions down enough to bring in buyers, and we see those buyers come in, and it pushes back, and then maybe it does this and then it fails. That's your opening swing. The first indication of a seller stepping in is the opening swing high. The first indication of a buyer stepping in is the opening swing low, and it stays that way for the rest of the session. And the reason it's important, not all sessions is the opening swing important. The reason it's important is it tells us what it can potentially, not always, but it can potentially tell us what the market on open orders, the MOO order types, these are orders that are preset to execute as soon as the market opens, what the extent of those orders are, what the extent of that order flow is. It tells us where its peak and where its low are. And what happens is you can just, the reason, it's subjective in a way, because you can argue, well, why didn't you use 35? You know, why did you stop at 37? Why you could use 35. Hey, go ahead and use 35 if that's what you want to use. It's a subjective thing. It's not a science. But essentially, what this is doing is it's helping me. It's creating a marker, kind of like a water marker, and it tells me as the market opened, here's where the initial, when the first flow of trades that came in on the open, here's where they started, here's where they stopped. And I put that up and I compare the rest of the session. There's also a statistic that I did a long time ago that needs a refresher. If we have an opening swing and the market pushes through that opening swing on an impulse and it comes back and breaches the opening swing, it has a high probability of testing the other side. So it sets up another trade. Although I see that less and less, that particular study hasn't been as consistent lately, but I see that all the time. It's just another yardstick like the initial balance, which is these yellow lines. The initial balance is the first hour low and high. The opening swing does not have a time frame, though.
Okay, good. There was another question that asked that, so I'm glad you said that. Let's see. Well, this will be the last question. If you're in the middle of a trade that is going your way, but there's a fundamental change that has yet to impact the market, i.e. negative news, should you modify how you will exit the trade as soon as possible, or should you still keep the same plan that you got into the trade and ignore how the news could impact your trade?
I don't ignore news. In fact, I have two news squawk feeds, and I have one. Well, those two news squawk feeds have a text feed, and I have desktop alerts. News means a lot to me. I'm not going to argue here that you should know the news and trade the news, although one of those news feeds is trade the news. What it does, though, is you have to understand that the market is simply a mechanism of pricing information. That's all. That's all it is. The fact that the market's trading at 21.32, right? That's given the best information the market has. That is what's considered a fair price right now. And news changes that. News can impact the valuation of the market. All of a sudden, 21.32 may be too cheap or too expensive. And if I'm long, and all of a sudden news comes across, and the way it works actually is the market will respond before you get the news. What these news feeds tell me is the extent to which I should respond to that news. That's really the key difference. It's not that I'm going to trigger or change things just because the news came across, but I'll see the market jiggle and kind of flush or something, and then it tells me, okay, this news came out, Yellen just said something. That's probably impacting the US dollar, the treasuries, and it's likely to trickle down to the ES, and I need to get out of the way. But I will, if the trade was on based on some setup, and all of a sudden it's moving in my direction, and it immediately in one quick impulse comes back to my entry, I am going to close that trade, because I would rather close it stand back a little bit, reassess, and re-enter the trade, than to sit there and go, I hope it continues in my direction. I hope it continues in my direction. I hope this isn't news that's working against me. It doesn't cost me much to enter the market. It costs me a lot more to give up ticks, because I just want it to hang on, because I don't like to enter the market that often, you know. So I do respond to the news as soon as possible.
Okay. Perfect. Thank you for the webinar. Thank you for the information across these 4 parts. They've been really informative, especially even just for myself. So I thank you. And
Awesome.
there's lots of comments and people saying thank you for the information.
Absolutely. Thanks for having me, and thanks everyone for listening. And I really invite you to kind of go to Futures.io and listen to these webinars again. And if you have questions, you can hit me up at FuturesTrader71.com/contact, or even better, hit me up on the AMA forum under my handle, FuturesTrader71 AMA. Ask me anything on Futures.io. That way everybody who's participated here can see the answers and can keep the conversation going. Thanks for tuning in, everyone, and I'll catch you next time, whenever that is. Thanks, Terry, for doing this.
You're welcome. Talk to you soon.
Thanks.